Recent note from Citi pointing to crypto weakness as a potential warning sign for equities, but saying liquidity could soon turn and revive risk assets into year end. For more, Dirk Willer, head of macro strategy and asset allocation at Citi. Dirk, it is good to see you as always. Let's start with that recent note from you all, Dirk, where you were talking about Bitcoin's recent weakness as sort of this warning sign for stocks. Since you've wrote that Bitcoin's even weaker, but start there, Dirk. What is this warning sign you're referring to?
Yeah, thanks for having me on. It's interesting actually that when the equity market was still doing really quite well, we noticed the divergence with Bitcoin, and it's actually somewhat rare. So Nasdaq and Bitcoin both trade with a positive correlation, and you had episodes in the past where Bitcoin diverged to the downside, and that was at times a negative harbinger. So we backtested that, and we found actually it's fairly reliable. So if Bitcoin trades below its 55-day moving average, the information ratio of the Nasdaq is just 0.5. If it's above, it's 1.5. And of course, both are positive numbers because we essentially were in a bull market for a long time. But there's meaningfully better performance for the Nasdaq when Bitcoin is essentially part of the bullish sentiment rather than when it's diverging.
What I thought was interesting too, Dirk, is you were telling clients that stocks were holding up despite that tightening liquidity because of, you were saying, the AI story, the AI narrative. And I was wondering if you think that disconnect you're kind of pointing to there, is that sustainable into year end?
Yeah, I mean, we're obviously hoping that Bitcoin catches up with the equity market rather than the other way around. And, one reason for hope would be this improving liquidity environment. Having said that, there were, of course, two more structural negative stories for the equity market. One was that the December Fed cut was put in doubt. And of course, a lot of the bullishness was based on the idea that, the AI story is very strong, the equity market is very strong, and maybe in a bubble. And the Fed is cutting into that. And that is, of course, a very bullish development because usually the Fed is leaning against these type of U.S. equity market moves. Now, if the Fed would not cut, that removes part of the bullish story. I don't think that would be the end of the bull market, but it would certainly lead to a pullback, and we're seeing part of that. Now, Citi still expects a cut. Our economists still think December will be a cut, at least if we should get the employment data, because they expect weak employment data for October and November. If that comes out in time for the Fed meeting, we expect the Fed cut. That might be helpful. The other point you question is AI narrative. That has also weakened, admittedly, and there were many questions asked about, OpenAI in particular and so forth, and that has led to a pullback too. But we don't forget we get NVIDIA earnings this week, so that could reset the AI narrative.
Well, on the AI, what's interesting, Dirk, is you have these questions. I'm curious to get your take on it, on this sort of AI-driven debt financing, big tech issuing billions in bonds. I mean, do you look at that, Dirk, and say, okay, that's healthy, or no, that's bubble behavior?
I mean, it's a normal part of what happens. In 2000, you had a lot of debt issuance, of course, for the internet build-out, and that was not the sign that the bubble was over at the time. And of course, the hyperscalers in particular have very strong balance sheet, negative net debt, and could issue a lot. I think it's more the neo clouds and so forth where people get more concerned. We saw some of the CDS markets starting to move. For some of the sort of smaller companies outside of the hyperscalers. And that is never a great sign, but I would say just because the balance sheet is so solid of the hyperscalers, there is a fair amount of debt capacity left, and it's just a matter of which companies will have to finance it.